Hi everyone, this is Steve Elwell, Chief Investment Officer of Level Financial Advisors, and this is your second quarter 2026 market commentary. The investment markets had a fantastic quarter. The U.S. stock market was up 15.44% in the second quarter. International developed stocks were up 10.22%. Emerging markets ripped higher at 24.05%. And even global real estate participated at 10.76% for the quarter. And the bond market actually had a pretty decent quarter as well. U.S. bond market up 0.67, and the global bond market, excluding the U.S., up 1.77%. The bond market had an interesting quarter as the conflict in Iran obviously took off in February, and the markets were affected by that in March. Oil prices spiked as a result of the conflict and the closing of the Strait of Hormuz, and that caused oil prices to go up, then gas prices to go up, then inflation expectations to go up. And when we started the year, the markets were expecting maybe 1 to 2 interest rate cuts by the end of the year. And as a result, a direct result of the war in Iran, that sort of flipped on its head. And now the market is expecting potentially either no changes to interest rates or even the possibility of a 1/4 point increase in interest rates to try and battle some of that rising inflation as a result of higher oil prices and higher gas prices. Now, the good news is with the ceasefire that came in mid-June and the cooling of tensions that sort of happened throughout June, oil prices have come back down, and the most recent inflation reading was a little bit better than expected. But time will still tell whether higher oil prices and gas prices will result in increasing inflation or lingering inflation, and how the new Federal Reserve Board Chair, Kevin Warsh, is going to handle that. I mean, he originally was sort of pegged as someone who was in favor of shorter or lower interest rates, and if inflation continues to persist at 3.5%, 4%, that's well above the Federal Reserve's target inflation rate, and they might not really have any choice other than to potentially try and raise rates to battle inflation. I say all that because it's having an effect on the bond market. Interest rates and bond values tend to have an inverse relationship. So if interest rates go up, bond values tend to go down. If interest rates stay the same, then bonds tend to just earn their interest and have that full form of return without much price movement. And if interest rates go down, then bond values tend to go up. Within the realm of our portfolios, most of our bond holdings are not only extremely high quality treasuries and corporate bonds, but mostly short term in terms of like 2 to 3 to 4 years of average maturities. Longer term bonds are really struggling though with this pivot from expecting a cut in interest rates to now maybe expecting an increase in interest rates, even if it's minor. That's a pretty big change for longer term bonds, which are always more volatile and more sensitive to interest rates. So the bond market has somewhat stalled this year. The first quarter wasn't particularly good, and the second quarter was a bit of a rebound, but still probably a little bit behind expectations of where bond returns, someone might have thought bond returns might be at this portion of the year. But as we showed on this DFA chart, stock returns for the second quarter and overall for the year have been fantastic and have done all the heavy lifting in terms of creating return in the portfolios through the end of June. Also, one thing that we found very interesting was ultimately what ended up happening with the price of gold. And we're going to show this chart here from DFA that shows the Bloomberg Gold Index overlaid with the S&P 500 index. The gold index is this yellowish color, and the S&P 500 is this sort of turquoise color. And it shows so far calendar year 2026 from January through the end of June. And initially in the year, along with last year, precious metals like gold and silver were going through the roof in 2025 and the early part of 2026. And then once, you can see, right as it got to the end of January and into February, once the Iran war began, all of a sudden that trade sort of flipped, and now all of a sudden gold prices are down 20% from where they were when the war started, which might be the exact opposite of what an investor in gold would expect. I mean, the traditional reason for buying gold, the thesis for buying gold and silver, would be a protection against uncertainty. You know, typically, or at least the belief is, when the markets go haywire, gold's a safe haven. Or when inflation goes up unexpectedly, inflation or gold will protect you from that inflation by also going up. And here we have a year where, you know, as of the end of June, gold's negative. We have higher than expected inflation, and we have a whole bunch of geopolitical uncertainty as a result of the war starting in February. I mean, it should be a Goldilocks scenario for gold investors, and it's the exact opposite. And that's part of the challenge of trying to use gold for something like that. My own personal opinion is, for whatever reason, there was a lot of speculation happening in the latter part of 2024 and 2025 that was pushing up the price of gold and silver. You know, I'm not going to speak to why millions of other people might have invested in it. Everybody has their own ideas. But I think there were more so than normal investors that were piling into the gold and silver trade. And, you know, keep in mind, sometimes momentum is just a thing in the investment markets, right? You know, you have investors who buy something just simply because it went up recently. It has nothing to do with a thesis, nothing to do with some type of geopolitical move or inflation expectations or central bank purchases or anything like that. It's just somebody saying, oh, look, this thing's gone up 20%. I think it's going to keep going up. I want to ride the coattails, so I'm going to buy it too. And the problem when that type of speculative investor gets involved in a trade, whatever it is, whether it's a stock or gold, the problem is once the tables turn and something like that starts to go out or out of favor, you know, easy money in, easy money out, right? The investors that maybe are thinking, well, I'm not going to call them investors, the speculators and gamblers that are thinking that way, they're essentially buying as long as the price is going up, and as soon as it starts to turn, they're just going to exit because there's not a long-term thesis there. It's a try to make a quick buck scenario. And I have a feeling that part of what's happened in this Goldilocks scenario with the war and with inflation being higher than expected is the price was already too high before those things even happened. There were too many people piling in from a momentum standpoint. And that made it really easy for prices to fall once the unexpected items ended up happening. Mainly the war had the major effect. But as you look on this chart, the overlay is essentially the S&P 500 also fell, you know, once the war started. But as tensions cooled off and the ceasefire came in June, gold just kept going down. Meanwhile, the S&P 500 starting in April rallied to new all-time highs. And like I said, gold is essentially down 20% from its peak, or 20% from its value on the date that the war started. So, you know, I guess somebody with that long-term thesis about protection against uncertainty and inflation would be scratching their head right now and saying, what's happening to my gold? Because I'm not getting what I paid for, which is part of the danger of investing in precious metals. One other thing that we touched base on in our quarterly commentary that I want to further touch base on, the quarterly letter that I want to further touch base on in the market commentary now, is we get a lot of questions, and we got some of this last year and more of it this year, and the longer the stock market continues to do well, I'm sure the more we'll get this question, which is, how is it that despite everything that's going on pick whatever market worry it is that you want to talk about. The war in Iran, higher oil prices, higher gas prices, higher inflation, slow economy, slow job market. Pick your worry. How is it that the stock market continues to move higher and strike new all-time highs? And the answer is that stocks tend to move based on corporate profits and corporate earnings. And the reality is that the expectations at the beginning of 2026 were that corporate earnings would grow by about 13% this year, which is a good number, right? It's a good number to start with. What changes stock prices is when new information becomes available that either confirms or increases or decreases that expectation of what earnings are going to be. Because every quarter we get updates, right? These companies come out and they say, oh, well, we earned X, and for the rest of the year we think we're going to earn Y. And as you might guess, if they report earnings higher than expected and then increase their earnings expectations for the rest of the year, the stock price generally tends to like that and go up. And so the year started with expectations of 13% growth for the S&P 500 or the overall market. And now expectations halfway through the year, so we have half of the data already. We know it. It's on paper and already booked. The expectations for earning growth for 2026 are now at 23%. So almost double what the year started at. And when you look at stock prices in terms of the S&P 500, and you look at what is it that somebody was paying for the earnings that are reported by the S&P 500, it's actually come down. In terms of earnings relative to share price paid, investors today are getting a better deal than what they would have received on January 1st. So that can be a hard concept to understand, but I'll try to give a really simple example. Well, let's say you paid $100 a share and your expectations were that you were going to get $10 of earnings. Well, I paid $100 and I'm going to get $10 of earnings, so I paid 10 times. The price was 10 times what I thought I was going to get in earnings. So I paid a 10-to-1 ratio. Well, let's say the actual earnings ended up being 15 instead of 10. And now the share price went up, for example, to 135. Well, now I'm paying 9 times. 9 times what I'm going to get in terms of earnings. 9 times 15 is $135 a share. So ultimately, in terms of that type of example, that's great news. That's exactly what you want to have happen in terms of both the short-term and the long-term outlook. You want a price to earnings multiple that is low or reasonable, and you want the earnings to be higher than what you expected you were going to get. And that's exactly what happens. Earnings were higher than people expected, and share prices have not risen at an equal pace to what earnings have increased by. So on this JP Morgan chart, this shows on the left side the source of earnings growth and profit margins. And on this green and gray chart here on the left, I ultimately want to just show on the sort of middle part of the page, you'll see on the bottom it lists 2023, 2025, 2026, 2027, and there's a little bar chart there that shows, it says 26F, and that stands for 2026 expected earnings at $340 a share for the S&P 500 and a 24% growth rate. And the two different shaded colors here, the green portion is a result of year-over-year growth of revenue, so representing 10.9% growth, which is pretty good really by any measure. but profit margin increasing by 13.7% year over year. And so when you add those two together, not only did revenue grow at 11%, but the profit margin grew by 13.7%. That's how you get a total of 24% year over year growth. And I can tell you right off the bat, you can see on all these other charts, 24% growth over the last 25 years has literally only been beaten 3 times. In 2021, in 2010, and in 2004. Every other year has been lower than that. It also gives a projection for 2027 and 2028 at 17% and 15%. I guess we'll see whether those happen or not. But in terms of seeing that growth, and even the last 2 years, 13% for 2025, 10% for 2024, 0 for 2023, you can see, well, why is it that the stock market's gone up so much? Well, look at the last 3 years, right? I mean, 10% growth, 13% growth, and 24% growth this year. I mean, those are pretty impressive growth numbers with expanding profit margins. In terms of an investment thesis, that's exactly what you want to hear. So you can understand why is it that people are paying higher prices for Google or some of these other companies. Well, if their earnings have gone up and their profit margins have expanded, that's about as good as it's going to get. And so, that you can see why investors are excited about that. But my point just is that it's not just price going up and the earnings not showing up, not helping support that. It's actually earnings outpacing price increases. So that's noteworthy, and if you're an investor, should give you confidence that these share prices, listen, that doesn't guarantee that they can't have a correction or go down 5 or 10 or 15% as a result of some type of new news that's not good. Maybe something like a Fed rate increase could be something that spooks the market a little bit, maybe not. It's not me saying that can't happen. It's just me saying that if you want support for today's prices, support in terms of saying maybe this isn't just some random bubble, but some real, this is really true prices that these stocks should be worth. The earnings are there. I mean, the earnings support that. And that's always the bottom line. It's always the bottom line. So one other thing that we wanted to show before we wrap up this second quarter commentary, the last few years there's been so much talk, probably even longer than that, 5 to 7 years, there's been so much talk about the Magnificent Seven, which is like this nickname that the investment markets have given to the big tech companies. So Apple, Amazon, Google, Facebook, Microsoft, Nvidia, and Tesla. And the Magnificent Seven have really kind of driven a lot of the big returns of 2023, 2024, some of which in 2025. And that story has really reversed here in 2026. It started to cool off in the fall of 2025, and since then has really been sort of stalled out. In fact, some of the stocks in that group of 7 have gone down quite considerably, including most notably Microsoft. And so we wanted to show this other JP Morgan chart here. Number one, on the right side, it shows in a green line, it shows the S&P 500 return for each of these 3.5 years, 2023 through mid-2026. But it also shows each of those individual stocks in the Magnificent Seven and what their return was for that particular year. And you can see, starting in 2023, I mean, Nvidia and Meta and Tesla, I mean, they just totally crushed it. They had monster years. And then in 2024, Nvidia continued it, another huge year, and virtually all the Magnificent Seven ended up outperforming, other than what looks like Google. And then in 2025, even a couple of them outperformed by so much that it ended up dragging the group to a point that would outperform the S&P 500. But then in 2026, that really has not happened. Other than Google, none of the others have outperformed the S&P 500. And as a group, if you look at the little box on the top left side of this overall page, it's showing the returns for every calendar year for the S&P 500 in gray, the Magnificent Seven in green, and then the other 493 stocks in the S&P 500. So sort of separating out within the S&P 500 the 7 tech companies, and then the other 493. And so far this year, the S&P 500 return is 10%. The Magnificent 7 combined is 0. And the other 493 is 15%. So this is a broadening of stock price increases. Everything else is catching up, and the Magnificent 7 is cooling off. And essentially the Magnificent 7 has contributed nothing to the S&P 500's return so far in 2026. And some of that, it's not really even a representation that they're not growing their earnings. It may be more so of really probably two things. Number one, that maybe their expectations were too high. Investors' expectations were too high. Stocks were, those 7 stocks were priced for even faster growth than what they delivered. But also concerns over the amount of money they're spending building out their AI infrastructure, which is hundreds and hundreds and hundreds of billions of dollars. I mean, it's no small amount. In fact, some of them are even borrowing money to do it, which is kind of outrageous given how much free cash flow they have and how high their profits are. And even in the case of one of them, I believe it's Google, is actually selling some stock to help pay for it, which investors generally don't like. So when you look at the bottom left part of this chart, the year-over-year earnings growth for 2026, you can see the year-over-year growth for the Magnificent 7 is 38%. That's fantastic. So how is it that their share prices are flat? Well, expectations might have been higher than that, and so 38% might be a disappointment. But beyond that, also the amount of money that they're spending on this build-out is becoming part of a concern for a group of investors. The other 493 has earnings growth of 19%, which actually crushes what the last 4 years has been for the 493. And that's really where I think you're seeing the broadening of earnings growth for the rest of the stock market. It's not just a story about all the growth is coming from just these 7 companies. Now it's a story of growth is happening in all sorts of places. And great examples are like regional banks and big banks, Bank of America, M&T Bank locally. I mean, look at their share prices. They've gone up enormously this year and over the last couple of years. So we thought we'd share some of this information, partially because some of it's interesting, some of it helps explain what's going on. Some of it is supporting what the current close to all-time high stock prices are for those that might be a little nervous that this is like some type of bubble. And again, we're not saying that there can't be a correction. Corrections are generally healthy. A 5 or 10% decline tends to be healthy, so markets don't get too overheated. But within the bond market, potential interest rate expectation changes, earnings growth, the conflict in Iran, all sorts of different things going on. And hopefully this helps give a little context and clarity to what does this all even mean. So for that, this has been the second quarter 2026 market commentary. I'm Steve Elwell with Level Financial Advisors, and we'll talk to you next quarter.